Hey everyone, welcome back to Corporate Decoder. Today, Rallybio Corporation, ticker RYLB, issued an S-4 filing about a proposed merger with Avenzo Therapeutics Incorporated. This is a big deal for Rallybio shareholders, and I am seeing some very interesting financial changes and risks ahead. Quick note, this is not financial advice, just my take on public filings for educational purposes. Alright, let's dive into the details. This filing is essentially a proxy statement and a prospectus, meaning Rallybio stockholders are being asked to vote on this merger, and it also acts as a prospectus for the shares that will be issued in the deal. The core of this is a merger between Rallybio and Avenzo Therapeutics, a company focused on oncology. Rallybio will essentially become Avenzo, changing its name to Avenzo Therapeutics Incorporated. This document was filed with the SEC on the 15th of July 2026. Now, what is everyone getting out of this? Well, it looks like Avenzo stockholders are set to own the majority of the combined company. Around 56.6% Rallybio stockholders after the deal are expected to hold about 2.8%. And the investors in a concurrent financing, which is basically a cash injection happening right before the merger, are expected to own about 40.6%. This is all based on some key assumptions about valuations, specifically $15 million for Rallybio after expected dividend payments and $300 million for Avenzo. And Rallybio stockholders are being asked to vote on several key proposals. The big ones are approving the issuance of new shares, which is standard in mergers, approving a reverse stock split. They are looking at a ratio anywhere from 1-for-2 to 1-for-9 to boost the share price and meet Nasdaq listing needs. They also want to change the company name to Avenzo Therapeutics Incorporated and increase the number of authorized shares significantly from 200 million to 500 million. Now, let's talk about the risks. There are always risks in these kinds of deals, but this one has a few specific ones worth highlighting. First, the amount Rallybio stockholders might receive as a dividend before the merger closes is uncertain. It depends on Rallybio's net cash, and that can change. Second, the exchange ratio for the shares is fixed, meaning if Rallybio's stock price fluctuates wildly before the deal closes, Avenzo stockholders could end up with much more or much less value than initially anticipated. Looking at Rallybio's business itself, their lead program, RLYB 116, is a complement C5 inhibitor for rare diseases. They also have RLYB 332 in preclinical development for iron overload. However, they've recently discontinued their RLYB 212 program due to disappointing clinical trial data. This puts a lot of pressure on RLYB 116 to perform. They also mentioned signing a collaboration agreement with Johnson & Johnson, but it was terminated in April 2026. What about Avenzo? They are focused on oncology, specifically advancing 4 clinical stage product candidates, CDK inhibitors and bispecific antibody drug conjugates, or ADCs. Their CDK inhibitors, AZO-negative 021 and ABZO-negative 023, are targeting HRE-HER2. Metastatic breast cancer, their ADCs ABZO-negative 1418 and ABZO-negative 103, are targeting various solid tumors including lung and urothelial cancers. Both ABZO-negative 1418 and ABZO-negative 103 have received Fast Track designation from the FDA, which is a positive sign for potentially expedited development. Let's look at the financials. For the first 3 months of 2026, Rallybio reported a net loss of $8.3 million. Which is an improvement from a loss of $9.4 million in the same period of 2025. This improvement comes mainly from lower research and development costs. They discontinued RLYB 212, which saved them money. However, general and administrative expenses went up, largely due to costs associated with the now terminated merger with Candid. Avenzo, on the other hand, is seeing its R&D expenses jump significantly. For the first 3 months of 2026, their R&D costs were $14.5 million, up from $9.6 million in the prior year. This is driven by advancing their various oncology programs into clinical trials. Interestingly, their general and administrative expenses dropped, mainly due to lower stock-based compensation costs. Now, let's see what the combined company might look like. The pro forma balance sheet as of the 31st of March 2026 paints an interesting picture. After the merger and assumed 1-for-5.5 reverse stock split, the combined company would have about $269 million in cash and cash equivalents. This is boosted by the $215 million from the concurrent financing. However, they are also accounting for $2.2 million in contingent value rights, or CVRs, which could be a future payout to Rallybio stockholders. Looking at the pro forma income statement for the first quarter of 2026, the net loss is projected at $25.9 million. This is a substantial increase from Rallybio's historical standalone first quarter loss of $8.3 million. The combined company anticipates higher R&D costs around $17.3 million, and general and administrative expenses of about $10.8 million on a pro forma basis. Getting back to the stockholder vote, Proposal 1 is about approving the stock issuance for the merger that will result in a change of control for Rallybio. This is necessary to comply with Nasdaq rules, as the number of shares being issued is more than 20% of what Rallybio currently has outstanding. Proposal 2 is the reverse stock split. They are asking for approval of a ratio between 1-for-2 and 1-for-9. The main reason is to boost the stock price and meet Nasdaq's listing requirements, which is crucial for staying on the exchange. Historically, about half of micro cap companies that do reverse splits end up delisted eventually. While this isn't a guarantee of failure, it is a pattern to watch. Proposal 7 is to approve the 2026 Equity Incentive Plan. This is basically a new long-term incentive plan for employees, directors, and consultants. The share pool they are asking for is quite large, 18% of the total outstanding shares, plus an automatic increase each year. This can lead to significant dilution for existing shareholders if fully utilized. Now, for the risks, they explicitly state that more financing will be needed in the future. This is a huge red flag for any company, especially one transitioning from clinical development to commercialization. They also warn that about half of microcap companies doing reverse splits end up delisted. That is a significant historical pattern to consider. And the whole deal might not even close if conditions aren't met, which could send Rallybio's stock price tumbling. Looking at related party transactions, we see that entities affiliated with Orbimed, SR1, Nebraska R, and Foresight Capital are heavily involved in Avenzo's financing. Some of Avenzo's directors also have ties to these investment firms. This is pretty common in the venture-backed biotech world, but it is always something to keep an eye on for potential conflicts of interest or deals that might not be purely arm's length. Overall analysis and takeaways scroll. So, what is the story here? Rallybio is essentially a vehicle to take Avenzo public through a reverse merger. Rallybio's own pipeline had some setbacks. Like the discontinuation of RLYB 212, the RLYB 116 program shows promise, but it is still early stage. Avenzo brings a more advanced oncology pipeline, which is the main driver for this transaction. However, the deal itself comes with significant risks, particularly the uncertainty around Rallybio's net cash position impacting the exchange ratio and the large number of authorized shares being requested, which points to potential future dilution. The stock split is a move to artificially boost the share price, historically a mixed bag for stock performance. The company's reliance on future financings is a major concern, and the history of reverse splits suggests caution. While Avenzo's pipeline looks interesting, the overall execution risk of this merger and the combined company's reliance on future capital are definitely on my radar. The report contains a lot of legal and financial minutiae, but the biggest red flag I am watching is the historical pattern of companies doing reverse splits, as those outcomes are often not favorable for long-term investors. That is my take. Stay decoded. If this analysis was valuable, hitting that like button and subscribing really helps, and check out the Discord in the description.